Late 2025, the headlines were everywhere. SCHD is dead. Move on. If you listened, you just missed an 11% year. The S&P 500 up 2%. So what did everyone get so wrong? First, let's get the basics straight. SCHD is a dividend ETF from Charles Schwab. It holds around 100 quality U.S. companies that pay you cash every quarter. Right now, it yields about 3.4%. SPY yields 1.1%. Hold that number, it matters in a second. For 2.5 years, SCHD looked like a bad bet. From 2023 through mid-2025, one trade ran the market: mega cap tech, AI, the Magnificent Seven, the usual suspects, Nvidia, Microsoft, Meta, you know the names. SCHD's rules don't let it chase those stocks. Its quality screens filter most of them out. So while QQQ ripped higher, SCHD sat there looking boring. The articles wrote themselves. Dividend investing is dead. Just buy the S&P 500. Then 2026 happened, and everyone who sold based on those headlines, they're now watching SCHD beat the market. But the real mistake wasn't the prediction. It was the question they were asking. Let's be fair for a second. Those writers weren't making things up. Over the last decade, SPY did outperform SCHD. The 10-year compound annual growth rate with dividends reinvested, SPY around 14.5%, SCHD around 12.7%. That's a real gap. Over 30 years, that gap turns into serious money. So if you're 25 years old with 3 decades of compounding ahead, there's a real argument for pure growth. That's what those articles were saying. And honestly, for one specific type of investor, they weren't wrong. But here's where the story falls apart. Investing isn't about the good years. It's about how your portfolio behaves when the good years end, because they always end. 2000 ended, 2008 ended, 2022 ended. The next one is coming too. We just don't know when. Look at 2022. The S&P 500 dropped 18%. SCHD held up much better. That wasn't luck. That was the design. When growth takes a hit, quality dividend payers tend to hold ground. They don't fall as far, they recover faster, and they pay you while you wait. But this is where most people miss the point entirely. A crash isn't the same for everyone. It depends on one thing. Do you need the money right now? Picture 2 investors. Both watch their portfolio drop 40% in the same crash. One is 25, still working, still adding new money every month. For them, a crash is uncomfortable, but it's opportunity. They're buying shares on sale. Time is their weapon. Now picture the second investor, 60 years old, retired, living off the portfolio. The same 40% drop, that's not a dip, that's a disaster, because they can't wait. They have bills, so they're forced to sell shares at a discount just to cover rent. Every share sold at the bottom is gone forever. And here's the brutal math. If your portfolio drops 50%, you need a 100% gain just to break even. You have to double your money to get back to zero. That's called sequence of returns risk, and it's the single biggest threat to anyone near retirement. This is where SCHD changes the math entirely. That 3.4% yield covers a meaningful chunk of your expenses without selling a single share. Fewer forced sales, less permanent damage, a faster recovery. That's the actual job of this fund. Not to win every year, to change how you experience the bad ones. But there's something happening with SCHD right now that almost every YouTuber is getting wrong. The 2026 reconstitution. And if you don't understand what it really means, you might make exactly the wrong move with your money. Every March, SCHD rebuilds its portfolio from scratch. It runs every candidate through a quality screen, dividend history, cash flow, return on equity, debt levels. Only the top 100 make it. This year, 25 names got added, 22 got removed, and the sector shifts were big. Energy cut by about 8%, healthcare up about 4%, tech up about 3%. New names came in: United Health, Abbott, Procter & Gamble, Qualcomm. Out went AbbVie, Cisco, Valero, Halliburton.
Here's the narrative going around YouTube right now. SCDHD sold its winners. Some of those removed stocks are up this year. The reconstitution was a mistake. I've watched entire videos built on that take. It's wrong, completely wrong, and here's why. When a stock price rises fast, something happens mathematically. The dividend yield drops. Even a great company becomes less attractive under SCHD's rules, not because the business turned bad, because the math no longer qualifies. So what looks like selling winners is really rebalancing away from stocks that outgrew their yield. What looks like buying losers is rotating into companies where valuations and fundamentals now look more attractive. SCHD isn't reacting to last quarter's performance. It's reacting to changing math, and that distinction is everything, because it means this fund is always positioning for what's next, not what just happened. Which brings us back to the real question, the one those articles never asked. It's not, is SCHD the best performing ETF? That's the wrong question. The right one is this: what does your portfolio actually need to do for you right now? The answer depends entirely on where you are in life. So here's the framework. 3 types of investors, 3 different answers. If you're in your 20s or early 30s, you've got decades ahead. You can stomach the volatility. You can ride out the crashes. For you, growth-heavy funds like VOO, SPY, or QQQ probably make more sense. SCHD isn't wrong for you. It's just not optimal. Time is your edge. Use it. If you're 10 to 15 years from retirement, the math shifts. You've built something real. Now you want to protect it while still growing it. This is where SCHD earns a real seat at the table, a blend of growth and quality income. So when the next 2022 shows up, you're not panicking. You're collecting dividends while the market sorts itself out. And if you're already retired or planning to live off your portfolio soon,
this is where SCHD's case is strongest. You need income. You need durability. You cannot afford to sell shares at a 50% discount to cover your grocery bill. A 3.4% yield on a real portfolio isn't a theory. It's cash hitting your account every quarter. Cash you didn't have to sell anything to get. So, was SCHD ever dead? No. It was doing exactly what it was built to do: underperform in a growth-driven market, outperform when conditions change. The articles didn't misread the numbers. They misread the purpose. If you want to see how SCHD actually pairs with growth funds in a real portfolio, I've got a full breakdown linked below. Same no hype approach, just the math. Subscribe if you want more honest investing breakdowns like this one, and drop a comment with which of the 3 investor types you fall into. I read them all. Keep building. I'll see you in the next one.